Hey guys, welcome back. So we're going to continue where we left off. So we were doing chapter number 13, which is properties of options. And in this chapter, just to remind you where what we had completed, we finished talking about the factors that affect option prices. And we said that the acronym for that was DIVITS. And we went through this table assuming all the variables go up in value, and then we redid the table assuming all the variables go down in value. Like I've mentioned before, this is an extremely important part, and we will be using this in valuations. We then quickly moved on to talking about the maximum we can charge our customer, the upper bound on an option price, and the lowest we can charge our customer, the lower bound on the option price. We discussed this for European call and American call, and then we discussed it for European put and American put. So we've already gone through this content. Before we were leaving, we were trying to rush through this particular section, which is called PutCall Parity. Once again, I emphasize, very, very important, because you're going to see this repetitively in multiple chapters, and it's going to show up on the exam day. So PutCall Parity, we said, is made up of two portfolios. One portfolio is called the fiduciary call, and the other one is called the protective put. The fiduciary call is made up of a call option plus a bond, which is the present value of the bond is what you invest in today. The protective put is made up of a stock plus a put. And we showed you in class that regardless what the market circumstances, both the portfolios are going to end up giving you the same value at the end. So the setup of the portfolio at the start has to be the same. We said put-call parity will only work if the assumptions hold, and we extensively went through the assumptions. Furthermore, what is more likely to show up on the exam day is when you're going to get an arbitrage related question. So they will give you details about one of the options, and then you will have to find out the price of the other option using put-call parity. And then they might tell you the price of the option in the market and then ask you if there is an arbitrage opportunity. And if so, how would you exploit it? So we've already seen these examples in class. We said that so far, all our discussion has been on options where the underlying pays no cash flow. But what if the underlying stock has a dividend? Well, then we need to go back and we need to adjust our lower bound for calls and our upper bound for puts. Technically, the lower bound for calls will go even lower due to the dividend paid on the stock, and the upper bound for puts will come down a little in regards to the cash flow. We said that we'll have to also make the adjustment to put-call parity. Guys, notice the adjustment is very straightforward. You know that once a company pays a dividend, the stock price is going to fall. The dividend is going to come in the future. So what you need to do is you need to discount the dividend back and then just knock it off against the stock price, and that is your adjustment. Whether you see it in the call or you see the adjustment in the put, you're knocking off the present value of the dividend from the stock price. Or you see the adjustment in the put-call parity, it's the same adjustment. Okay guys, so let's get on with your homework. So this is where I had left you at the previous class. The price of a European call that has a strike of 10 and expires in 1 year is exactly $1. So your call is worth $1 and it has a maturity of 1 year. The underlying stock is at 9, so the stock is trading at 9, and the risk-free rate is 3%. So your RF is 3%. The stock expects a $2 dividend in 6 months. So that's your dividend that you're expecting, and that's the time in which the dividend is going to come. If a European put option with identical maturity and strike price trades at 3, so this is what the put is trading at, what is the arbitrage opportunity? Since they've asked you about a call and a put, you know they're going at put-call parity. So let's quickly lay down our formula. If you remember the formula, it's sip Pepsi, be cool. So you've got the stock plus the put. It has to equal the bond plus the call option. So if you recall, if we have a dividend, we have to find the present value of the dividend and knock it off against the stock price. So we're going to knock off the present value of the dividend against the stock price. All right, so let's start plugging in the numbers. The price of a European call that has a strike of 10. So the strike is your K. So we're going to put that here, 10. E to the power, your risk-free rate, they said was 3%. And these options are going to last for 1 year, so T is 1. They said that the price of the call is $1. And the stock is trading for 9. We have to calculate the present value of the dividend, so we will do the dividend is $2. Now the dividend is expected in 6 months. So you're going to discount it back for 6 months. Please be careful. The maturity of the option is not the same as the maturity of the dividend or the payment of the dividend. The option matures in 1 year, but the dividend gets paid in 6 months. So we'll discount the 2 back by e to the power minus 3% for 6 months, 6 by 12. And then we're going to add the put, which is 3. Now, because I have all the components in my formula, I'm not really solving for anything. Basically, there's nothing to solve for. There is no missing element. So what I'm going to do is I'm going to maintain both the sides like a weighing scale, and I'm going to solve for one side versus the other side, all right? So this is where I miss you guys, because I have to do the math myself now. So we'll have to find the present value of this. I'll do 0.03 minus second e into 10. So this gives me 9.704 plus 1. So this becomes your 10.704 is equals to, and I'm going to find the present value of the dividend. So that's going to be 0.03 negative into 6 by 12, second e into 2. So that I get 9 minus 1.97 plus 3. So let me just quickly do the math. So on this side, I get 10.029. You can see that the two sides don't weigh up accordingly. So the put side is cheaper and the call side is more expensive. The rule of arbitrage is always buy the cheap. So you buy the cheap. And you always sell the expensive, so you sell that side. So guys, let's travel back up. You want to buy this portfolio, buy the cheap, and you want to sell that side. You want to sell that portfolio. You want to sell the expensive. That's how you make money. Okay, so the choices are no arbitrage possible. We're going to delete that because we know arbitrage is possible as there's a mispricing. Short the put for 0.35 present value. Well, no, because we said that we want to buy this side, so we're not going to short the put. In fact, we have to buy the put at the very least, so that's out. Yes, so this makes sense. Buy the put, okay, for 0.67 present value profit. To calculate the profit, remember, you still have to take the difference between the two sides. So if you quickly take the difference between the two sides, I'm guessing there has been a rounding issue, but if you take a difference, let's see what we get. So 10.704 minus 10.029, we get 704. Oh no, it's a perfect. So we get 0.67422. And that's our answer. That's our profit because that's the difference between the two sides of the portfolio. So then we get answer C. Why not D? Because it says invest in cash. Remember, cash is represented by the bond, and we have decided that we need to sell this portfolio. So if you're selling a bond, you're actually borrowing money. Please remember, when companies sell bonds, they collect money from people. They're not investing in cash. So that's also incorrect. It should have been borrow the cash, sorry. It should have been borrow the cash. So the D is incorrect. So you go with answer C. Let's look at question number 2. A non-dividend paying stock is currently priced at 50. While the riskless rate is 4%. So that's your stock, and the risk-free rate is 4%. That's your RF. Okay. At the money put with a 9 months to expiration has a price of 4. So that's your put, and that's the life of the option. Notice how they've hidden it in English. Like they've written 9 months, and sometimes they might even write NINE in case when you're reading very fast, you just jump this kind of information. So be careful. So that's your life of your option. What is the initial cost to write a covered call if the written call option is also at the money with 9 months to expiration? So this is where I need to tell you what a covered call is. You'll be studying that in the next chapter. If a dealer sells a call option, I repeat, if the dealer sells a call option, he's giving someone else the right to buy. That person who he gave the call to will exercise his option when market prices go up. Calls are used when market prices go up. Now, if the market prices go up and that guy uses his call, that means the dealer then has to deliver the asset, which means the dealer will have to go to the market and then buy the asset from the market. That's going to put the dealer into losses. So what the dealer does is when he gave the call option to the customer. At the same time, he will cover his position and he will buy the stock from the market. So in the event that guy exercises the call option, we are ready with the stock. All we have to do is, he has the right to buy, we are forced to deliver, we have the stocks, we have nothing to worry about. So that's what a covered call is. Let's write that down. A covered call is when you sell a call plus you long the stock. So you give someone else the right to buy, and if he buys, we're ready, we got the stock in hand. Okay, so this is going to be written as plus S minus C. Now here's the beauty about put call parity. You can shuffle things around and you can get what you want. So according to put call parity, let's quickly write this down. Sip Pepsi, the bond, B, and then cool, right? We remember want S minus C. So let's shuffle the equation to get what we want. So we'll take the C to the other side, and this becomes S minus C is equals to K E minus RT minus P. All right. Now let's look at the stock. So the stock they told us is worth 50. Okay. Since I need to find this, I really don't have to put anything in here. I need to just solve for this, right? They told us that the 9-month put option has a price of 4. So this is the price of 4. Now, here's the thing. They haven't given me a strike. They just told me the stock is 50, the risk-free rate is 4, and the put is, risk-free rate is 4, and the put is also 4. Where's the strike? Well, the hidden buzzword is it's at the money. Remember, when you're at the money, the stock price and the strike is the same. I repeat, when you're at the money, S is equal to X. Or S is equals to K, all right? So please remember K and X, I keep interchanging them. They basically mean the same thing. So we will have at the money, which is 50. So e to the power minus, our risk-free rate is 4%. Remember 9 months, so 9 by 12, and then minus 4. So we just gotta work out what is this gonna be, because that's gonna be our covered call. Okay, 0.04 into 9 by 12 negative second E into 50. So this gives me 48.522 minus 4, which then gives me 44.522. So your answer will be C. That's the cost of the covered call. Okay guys, so we're going to start off with put call parity for options on forward. So let's get this straight. This is an option on a forward contract, and the forward contract is on an asset. So it's like a derivative on a derivative, and the derivative is on the asset, kind of like Inception, where you're doing like a dream inside a dream, right? Again, don't worry, it's very straightforward concept. I'll just take you from the top again. So it's an option, the right to buy or sell. The underlying is the forward contract, and remember the forward contract is a commitment to buy or sell the underlying asset. So how can we do put call parity for options on forwards? First, we'll write down the one relationship that we know between the stock price and the forward contract. So we know that the forward price is equals to spot. And because we're going to make the purchase in the future, we got to pay the shopkeeper time value of money. We'll take spot e to the power RT. Remember, we're taking it to the future, right? So if I was to shuffle this formula, and I took the e to the other side, this will become forward divided by ERT, which is equals to spot. Remember, when you have something divided, you can write it in the power of minus. So we can write this as FE minus RT is equals to spot. Now park this aside. Basically what this is saying is, if you took that future price and you discounted it back, it'll be the spot, duh, right? So we're gonna park that on the side. Now let's write down our put call parity formula. Our put call parity formula is stock plus put. So sip Pepsi is equals to bond. So that's your B, and then the cool, the call option, right? So what we're gonna do is, you can see the similarity now. You can simply just take this and plonk it in here, because this is the spot, right? So now we rewrite the equation as call plus K E minus RT is equals to F E minus RT plus P. Now it seems like that there are two variables that have the same common E minus RT, so we can take them together. So put call parity for options on forwards can be written as call plus K minus F E minus RT is equals to put, right? Now, the way I have written the put call parity is with continuous compounding. Of course, you can also write it in terms of regular discounting. So that will be C plus K minus F or X minus F. Remember, K and X are the same thing. Instead of doing e to the power minus RT, you can just discount it by 1 plus RF to the power T is equals to the put. How will they test me this, Sheila? So they will just give you the components and they will ask you to solve for the missing one, or they'll ask you to do arbitrage. So if you have these components, they should equal to this. If not, there is a disparity on both sides. You found arbitrage, there is a mispricing. Cool? All right, so we're now moving on to American versus European call options, no dividends. So this was the concept that I was trying to get across before we guys left on our lovely distance learning break. And we were discussing this concept about American options. Granted, they allow you to exercise early. You can exercise them anytime. But will we exercise an American call option early? Well, here's the thing. Call options are the right to buy. Why would you want to buy now when you can buy later? Paying money now is like you got the money out, but paying later means that money you can keep it in the bank account and keep earning interest on that. So that's one reason why you should not exercise the option early. The second reason is, let's just say the option's deep in the money, right? So it's actually beneficial to exercise. But if the option still has time to go, why exercise and kill the option and then lose that time value? Instead, you can take that option, you can walk over to someone and say, hey buddy, this option is in the money. Why don't you buy it from me, right? And pay me the gain, because I'm giving you something with a gain in it, plus pay me the time value. So by selling the option, you can get more from it than by exercising it, by killing it. So we're just going to reinforce that concept that American call options, especially if it's on a stock that doesn't pay dividends, should not be exercised early. All right. So question, should American call options on a non-dividend paying stock be exercised prior to its maturity? No. And for example, consider an American call option with a strike 50 and a stock price 80. Assume that the underlying pays no dividends. It's a very important assumption because you can see I put that in blue here and I've underlined it here. It's very, very important because the situation will change otherwise. So we have to assume that the underlying stock pays no dividends. Okay, the option still has 3 months to expiration. Shall the investor exercise the call option? The explanation is, again, no, don't exercise the option early. Although one might be tempted to exercise the option early to book a profit of, so you have the right to buy at 50 and the stock is at 80. The difference, you can save 30 bucks. So you could save 30 bucks. Remember, each option is for 100 shares, so you could be saving like $3,000. But still, we will not exercise the option early. It is better not to exercise before maturity if interest rates are positive. So we're going to look at it from two perspectives. Every call option owner has one of two objectives. Number one, investor desires to exercise the option and keep the stock. That is, you want to remain invested in the firm. So if you exercise the option, you're going to hold the stock, you're not going to sell it. Number two, investor does not wish to be invested in the stock. The whole point of buying the option was so that you can make a profit on it. So you want to exercise the option and you want to get the stock and then you want to sell it in the market to make a quick profit, right? So we're going to look at it from both perspectives. So we'll start with the first one. The investor intends to keep the stock. So let us assume that the investor did exercise his call option 3 months early. Remember, the stock in the market was at 80. Your call option gives you the right to buy at 50. So you pay 50 and you bought the stock. Now imagine at maturity, if after 3 months, the stock price was above 50. So the stock is above 50 now, and at maturity, it is also above 50. Well, then you would still exercise the option, right? Whether you exercise it now, because stock is above the strike, or you exercise it at maturity because the stock is above the strike, you would pay 50 anyway. But by paying 50 early, remember, you missed out on the interest. So the investor could have exercised the option at maturity and still paid 50. The benefit of delaying the option exercise would allow the investor to earn interest on the 50 strike, right? Now think of it the other way around. What if you paid 50 and you got the stock? So you exercised the option early. And then turns out at maturity, the asset price is down, it's at 20. Well, then you ended up paying 50 for nothing. If you really wanted the stock, you could have just bought it for cheaper later. So if after 3 months at option expiration, the stock was below the strike at 50, below the strike 50, let's say at 20, then the investor has made a loss by exercising his option early, that is paying 50 for an asset where he could have only just paid 20 to buy it, right? So that's from the perspective of some investor who wants to own the asset. What if the investor does not wish to own the stock, right? He just wants to make a quick profit by exercising the option and then selling it in the market. So if the investor exercises the option early, it would yield a payoff, and that payoff is what we call the intrinsic value of only 30. Remember, I'm reminding about the facts. So we said the stock price in the market right now is 80 and the strike is 50. So if you exercise now, you would capture the 30, right? That's the intrinsic value. Instead, like we're saying, the option could be sold for more than its payoff. That would be payoff plus time value. Let me remind you guys. If we have a call option, right? A call with the right to buy at a strike of 50. If the asset price in the market is 50, right? There is no benefit to the option. Does that mean the dealer will give you this option for free? No, he will still charge you a premium, right? And that premium will depend on how long this option is going to last. Because if it's a 6-month option, you've got 6 months for the asset to move in your favor. So the premium he will charge you probably $6, $1 for a month, right? That premium is time value. So this goes to say that any dealer will always charge an option premium that is time value plus the payoff. Now imagine a situation where the stock is now 80. So if you're going to buy this option, right, the dealer is giving you a voucher that allows you to buy the stock at 50, even though the market is trading at 80. So the dealer himself is putting himself in a loss of 30 by giving you a voucher with an inbuilt gain of 30. So he's not a fool. He's not going to give it to you for free. So whatever you are going to be making, he will charge that 30 plus time value, 36. That would be the option premium, right? So option premium is the sum of intrinsic value plus time value. For at-the-money options, remember, at-the-money options is when the stock price equals the strike. So there is no payoff. There is no intrinsic value. So then the intrinsic value is 0, in which case the option premium equals the time value. And that's the example that we were talking about at the beginning. So if the stock price equals the strike price, there is no benefit in this voucher, then like we said, the dealer's not going to give it to you for free. The dealer's going to at least charge you $6, and that $6 is for time value, right? So this is a very, very important equation. I'm going to star that because we're going to keep coming back to this one over and over again, especially in valuations. Very important equation. Okay, so let's demonstrate this equation on a graph. That's how important it is. So let's demonstrate this equation on a graph. That's how important this equation is. So if you recall, we've discussed the payoff pattern for a call option. Remember, call option is the right to buy at X. If the asset price goes up, you'll make a gain. But if the asset price goes down, no call option owner will exercise his option, so the payoff profile is flat. The blue line is what are all the possible payoffs for a call option at maturity, right? So the blue line is the payoffs. And remember what we call the payoff. We call the payoff the intrinsic value, right? Now, remember what we said. This is the payoff at maturity. The blue lines represent a dead option, which has finished its life. But so what would the option be worth before its maturity? Remember what we said. The option is worth its intrinsic value plus time value. So what we're going to do is we're going to take the blue line, which is just intrinsic value, and we're going to add, increase. You can see this. We're adding everywhere the increase in time value. So this dash line tells us the option value when it is alive. So the option premium, the dash line, which is payoff, intrinsic plus time value. And you can see that when the option is alive, it's not two solid lines. It's actually a curve, right? And that's very, very important because we'll need that later on. So the option premium on this side is related to the stock price, that side, and it's a sum of the intrinsic value, which is payoff, plus time value, all right? So going back to our argument, the fact that American call options should not be exercised early. Well then, in that case, shouldn't then the American call option be worth as much as the European call option? Because even those guys are not, you cannot exercise those guys early, and that's true. So that's why we say Americans are always worth at least the European, if not more, right? So since American call options on non-dividend paying stock should not be exercised early, American call options should be priced, or the premium should equal the European call options. Right. Now, if you remember in the previous chapter, we spoke to you about options given by companies to their staff. That's called employee stock options, right? And if you recall from that, we said if a company gives options to their staff, the staff are not allowed to sell those options. The staff are not allowed, when they're leaving the company, they have to they either forfeit them or they must use them. So then staff tend to use their options early. Is that a wrong thing that they do? So let's look into it. So recall, vesting period is the period over which employees cannot exercise their options. However, once the vesting period is over, most employees exercise their options before maturity. So as soon as that window where you're not restricted from exercising is finished, all employees rush to exercise their options early. Questions, why? So is this behavior by employees suboptimal? The answer is no, they're doing the right thing. This is because most employees fall under category number 2. They don't want to remain invested in the stock. Why? I mean, aren't you working for the company? Don't you want to hold the stocks of the company? No, guys, that's against risk management. If your job is tied to the company and then your wealth is also tied to that company, should anything happen to that company, should they go bankrupt, not only have you lost your job, but you also, your portfolio, which is including those stocks, that portfolio also tumbles. So a good idea is not to put all your eggs in one basket in the same company that you work, but you should spread your money out. So most employees don't hold on to the stocks of the employer that they work with. So they do not wish to own the stock since employees cannot sell their options and may forfeit the options upon leaving the firm. They exercise them early to cash in on the profits. Now we're going to change the story. Now we're going to ask, what if the underlying asset pays a dividend, right? So American versus European call option with dividends. Now the question is, should American call options on a dividend paying stock be exercised prior to its maturity? Now the answer is a little tricky. It's a yes and a no, because a call option is a right to buy. If you exercise your right to buy a little in advance, then you will have the stock and then you can be the rightful owner to receive the dividends. So that's a very tempting reason to exercise your option, right? But at the same time, what if the dividends is like a little measly little few peanuts, which really doesn't matter? Well, then again, we go back to the same argument going, maybe it's not worth exercising your option. So we need to put this more mathematically, we need to put it more clearly, so let's go through it. So the answer is yes or no, and it depends on the size, not the side, sorry, size of the dividend. Only one side receives the dividend, which is the investor. The company pays the dividend. Okay, so the decision to exercise the call option early depends on the option moneyness, the size of the dividend, and the timing of the dividend. That is how soon the dividend event occurs prior to option maturity. Imagine a situation where you have a call option, right? Remember, call, right to buy. So with a strike of, let's say, 85, and the stock price is right now in the market at 88. So you have the right to buy at 85, stock is at 88, you can save $3. If the company is coming up with a dividend of 5, imagine if this dividend gets paid, right? And this dividend is coming in, let's say, 2 months. And your call option will expire in 6 months. So if this dividend gets paid, what happens to the stock price? The stock price will fall, and the stock price after the dividend will go down to 83. So your option is going to go out of the money. Right now, the option is in the money. So maybe one of the reasons you would exercise the option is so that you can pocket the 3. You got to buy the stock cheap by $3, but then you also got to pocket the dividend of 5, right? So when dividends are paid, the dividend causes the company's stock price to drop by the amount of the dividend. As a result, it may be optimal to exercise the American call options early. Notice how they're saying, not definitely saying it's optimal, it's maybe. Again, because there's one more thing we need to look at as to what is the benefit of exercising early? You get the dividend. But then what's the cost to exercising early? Remember, a call option is a right to buy. You gotta pay money. Why pay now when you can pay later? So I need to compare the difference between paying now versus paying later, okay? So exercising a call option early will require the investor to pay the strike K now. Exercising the call option at maturity or exercising the call option on the next dividend date will delay the purchase, and the purchase will be K then. So if it's the K in the future when you exercise, discount it back, that's the cost for today. So cost now or versus cost in the future, discounted back. So if the difference between exercising the option now K versus exercising the option at maturity, KE minus RT, is greater than the dividend, then do not exercise the call option. Because what we're effectively saying is the cost of early exercise. Remember, what's the difference between now and the later is the interest you're earning. If the interest that you're earning on your money between now and the future is a lot more than the dividend, then chuck the dividend. Don't exercise the option. Hold your position till the end and then exercise at maturity. But said the other way around, if the interest that you're earning on your money is less, if the difference between exercise now and exercise in the future is less, and the dividend is big, then that's it. Exercise the option right away and secure that dividend for yourself. So exercise the call option early. Okay, so let's put this into an example to see when we would exercise an American call option early, right? So an American call option on a stock has an X dividend date in 2 months and 5 months. The dividend on each of the X dividend dates is expected to be 0.5. So let's put this on a timeline. American option, and we're gonna get a dividend in 2 months, 2 by 12, a 0.5 dividend, and another dividend in 5 months, so that's 5 by 12, another 0.5 dividend. They told us that the stock price is 40 and the exercise price is 40, so it's an at-the-money option. No reason to exercise it now because it has no benefit. And the stock price volatility is 30%. You can ignore the stock price volatility, it's unnecessary information. The risk-free rate is 9%, that's something we need. And time to maturity is 6 months. Okay, so taking it from the top. It's a 6-month American option. It will mature at 6 by 12, 6 months out of 12 months. And we're getting 2 dividends, one at 2 by 12 and another one at 5 by 12, right? We need to determine if the American option will be exercised prior to maturity. If yes, when would it be ideal for the investor to exercise this American option? So remember, we exercise the American option if the dividend that we can seize is more than the cost of early exercise. So at T2, we will compare, is the dividend big enough than the cost of early exercise, exercising now and paying the full K versus exercising at maturity. Now, if you're exercising at maturity, the cost of that today is a discounted value. So you'll do K E minus RT. But here's the thing. Because we have a second dividend, we probably will not wait all the way to maturity to exercise. Our decision would be to either exercise now, exercise the next dividend, or exercise at maturity. So when we're going to calculate this guy, we're saying, shall I exercise now, pay K, or should I wait for the next dividend day and exercise then? Right? So this T is not going to be maturity. This T is going to be until the next dividend date. Okay? So let's put this in together. So dividend is 0.5. If you exercise the option now, you will have to pay, the strike is 40, the exercise price is 40. And if you exercise later, the next window will be for the next dividend, right? We will put that 40 here. So from the next dividend, which is coming at 5 months, to the current dividend, which is in 2 months, you discount this back, and 5 minus 2, so that gives you 3 months early that you're looking to exercise. So you'll do e to the power minus 9%, 3 by 12. Right, remember 3 because you're either going to exercise now or consider exercising the next dividend date. So the difference between these two is 3 months. Okay, so let's calculate this bit. So that's why I missed you guys. 3 by 12 into 0.09 negative. Second e into 40. So I got 39.11 for this one minus 40. So for the difference of the two, I got 0.8899. And I compare this with the 0.5. Now you can see that the dividend that I'm going to get is really small. And the cost of early exercise is 80 cents, 88 cents. Why would I pay 88 cents more to exercise my option now only to get a measly 50-cent dividend? So do not exercise. Do not exercise. So if you did not exercise here, you will get another dividend at 5 months. The question is, shall we exercise here? And so we have to redo the analysis, and we're going to ask ourselves, what's the size of the dividend versus the cost of early exercise? Now remember, the next day when you will exercise is at maturity, because that's the next window, right? So you will compare the cost of exercise now versus the cost of exercising at maturity, KE minus RT. And if the dividend is bigger than this, remember, then you will exercise. So we'll put the numbers in. Dividend is 0.5. Early exercise, exercising now, exercise price is 40. So we put that in here. Exercising until the next day, which is maturity, which is 40 here again, e to the power. And now you need to bring this back 1 month, because the next period to exercise is just 1 month away. So 9% for 1 by 12. And let's do the math. So for this side, 0.09 negative 1 by 12, second e into 40. I got 39.701 versus 40, and then the difference is 0.2988 versus 0.5. Now it makes sense to exercise early because you're spending around 30 cents extra to get the stock, but then you're going to get back 50 cents. So technically, you're still going to be better off 20 cents. So you will exercise early. So you will exercise this 6-month American call option early, that is on the 5th month, to secure the second dividend. I hope that's clear now. Okay, so now let's move on to American versus European put options, no dividend. So do we have the same argument with put options? I mean, if it's an American put, shall I exercise it early? Absolutely yes, because American put is the right to sell. And if you sell, you collect money. You absolutely want to collect money early and not later. Remember guys, the difference with a call option was a call is the right to buy. With calls, you pay money. When it comes to paying money, no, we don't want to pay early. We want to pay later. But when it comes to collecting money with the right to sell, you want to collect money as soon as possible. Okay, so should an put option on a non-dividend paying stock be exercised prior to its maturity? Yes. American puts should be exercised early, especially if the option is deep in the money. Since the stock does not pay a dividend and there is no added value from holding the stock, I mean, it's not going to give you anything, might as well sell it off and get rid of it. Get the money from it so you can put it in the bank account and start earning interest. So investors should sell the asset for K now, deposit the proceeds to earn interest. Delaying the sale will just harm the investor, because delaying the sale means you're losing out on the interest you could be earning. Will cause the investor to forego interest income. However, it's not without problems. If you exercise your put option early, remember what you're doing. You're selling your asset. What if that asset goes up in value? You lose out on the potential of the gains in the asset. So That's the key drawback of exercising a put option early. So a key drawback to exercising the option early, in the event the asset price at maturity is above the strike, exercising the put, that is selling it early, the investor loses out on the upside potential of the stock. You could have had a winning stock on your side, but you got rid of it. As a result, the decision to exercise early involves a trade-off between receiving the strike price now to earn interest on it, or the potential for the asset to go up and above the strike price. So it's like, do you want to get the money out and then earn interest, or do you want to let it be and see if the stock shoots like a star so you can make money off that? Okay, so just like we looked at the relationship of a dead call option at maturity, and then a call option prior to its maturity when it was alive with time value, we have a similar diagram for you guys when it comes to put options. Again, a very important diagram. So the relationship of a put premium or price with the stock price. Remember, with a put option, you have the right to sell at X. If the asset price is above the strike, you're not going to sell it for X. If the asset is above, go sell it in the market, right? But if the asset price goes below the X, now you have the right to sell for X, you will. So when the asset price goes down, remember when assets go down, you exercise puts. So the put comes in the money. Remember, the blue line is the dead option. It's what the option will be at maturity. It's all the payoffs at maturity. But when the option is alive before maturity, it has time value. Remember, the option premium is its payoff, which is the K minus S. Remember, the payoff of a put is K minus S. That's the maximum of K minus S or 0. So either you would do nothing or you would benefit plus time value. So if you add time value everywhere to the blue line, it will result in the red dotted line, right? Or the dashed line that is with the time value. So you can see that when the option is alive, when the put option is alive, it's not two solid lines, it's a curvy relationship because it includes time value. Guys, as time goes by, that dashed line slowly moves down to the solid line, and eventually the option converges to those two dead solid lines. And that's how the option behaves. So American versus European put options with dividends. Now, what if you have a put option on a stock where the stock pays dividends? Well, in that case, now you don't want to exercise early. I know this is getting confusing, so I have a summary for you guys at the end of this chapter. But for now, just bear with me. If you have a stock with dividends, you don't want to exercise your put. Your put is a right to sell. If you sell your stock, you lose the dividends. So you want to hold on to your stock, don't exercise that put, collect the dividends, at least until the dividends are received, and then sell it, right? So in the presence of dividends, it makes it less likely for put options to be exercised early. Exercise of the option requires the investor to sell his underlying asset, which will cause the investor to forfeit his dividend. So this is actually a trade-off. Should I hold on to the stock and not sell it? Well, then you're losing interest income, because remember, by selling early, you earn interest income. Why are you holding on to the stock? Because of the dividend. So once again, we need to make a comparison. What is the interest that I'm going to earn by selling early? And what is the dividend that I lose out by selling early? Whichever one is higher. If the dividend is bigger, hold on to the stock. If the dividend is smaller, then sell the stock and earn the interest on the stock, right? Okay, so if the dividends are bigger than the benefit of early exercise, do not exercise the American put option early because you want to keep that dividends. So in summary, as a result, the investor is less inclined to exercise the put if future dividends are expected to be large. Hold on to that stock, don't sell it. Stock price is anticipated to increase. If the stock is going to go up, well then, why do you want to sell your shooting star? Hold on to your stock. It's going to do well, and you don't want to just sell it off for peanuts, right? The time to maturity is long, so there's a lot of time value in your option. You don't want to kill your option by exercising it early, then you might want to consider selling off your option to someone else. And interest rates are low. Remember, the whole point of exercising a put option early is so that you can get the selling price, put it in the bank account, and start earning interest. But if the interest rates are low, then there is no point, right? And then you will not exercise your put option. So here's a summary. In case all of that was very confusing, you can rely on this one slide to summarize it all, right? So on the sides here, I have the information about the American call and the American put. And on top here, I've mentioned whether the stock has no dividend or the stock has a dividend, right? So let's get started with the American call. Remember, it's the right to buy. Let's put it down there. So American call is the right to buy. That means you want to pay money, right? Now, if the stock has no dividends, why'd you want to buy it? Right? Why'd you want to pay money early? So you will not exercise early. So do not exercise early. Why pay K now when you can pay the K later? If the option is deep in the money, remember, still don't exercise it. Sell off the option to someone else. You'll get the payoff plus time value. So the American options lower bound is the same as the European options lower bound, which is the call premium is the stock price minus the K discounted back because it's not getting exercised early. However, if the underlying asset has a dividend, now you maybe want to buy the asset early. You want to pay now because by buying the stock, you get your dividend. Remember, you will only do that if the dividend is big enough. Big enough compared to what? Versus the cost of early exercise. So exercise early if your option is in the money and the dividend is larger than the cost of the early exercise, and the time to maturity is near. Because if the time to maturity is near, there's anyway no time value left. So there's no harm by exercising the option and losing that little time value, it's fine. So then in that case, the American option lower bound is now revised to the lowest price for an American would be S0 minus K. Notice I'm not discounting the K because I'm going to exercise it early because it has a dividend in it. Okay, let's move on to the American put. Remember, the put is the right to sell. And with the selling, you receive money. Right? So if you're going to receive money, and if the stock has no dividends, then why are you holding on to the stock? It's not going to give you anything. Get rid of the stock. Get the money out of it, right? So you will exercise early. Sell the asset for K now to earn interest on the proceeds. Do not exercise early if interest rates are low. Because there's no point in selling your stock and then getting the K and then putting in the bank account to earn nothing. So if interest rates are low, then don't exercise. Or if you have a strong belief that the stock is going to shoot up, then don't sell it off now. You want to hold on to the winner, right? So if interest rates are low and or if high potential for the stock price to rise. In that case, the American put lower bound, because we're saying we're going to exercise early, the American put lower bound is S0 minus, there's an issue here. So the put option lower bound will be K minus S0. Okay. But what if the underlying asset has a dividend? Well, if the underlying asset has a dividend, well then hold on to the stock. Why'd you want to sell it? Because by holding on to the stock, you can collect your dividends. Then you're not going to exercise early. So do not exercise early if the dividends are larger than the benefit of earning extra interest. The time to maturity is long, so you don't want to exercise early and kill the option. You will lose all that time value. The stock price is increasing, so remember, you don't want to lose out on the winner. And then lastly, interest rates are going down, so there's not much to earn. Once again, in that case, because you're not going to exercise the option early, then the put lower bound becomes K at maturity, discounted back because you're not exercising the option early, minus S. Remember, because the underlying asset is paying a dividend, you have to knock off the present value of the dividend from the stock price. So guys, with that, the chapter comes to an end. Remember, this is the main important slide. In case you didn't like the slides earlier, you can rely on the summary to get the understanding of which American option is exercised early and which one's not. We'll move on to the next chapter in a bit.